Hello there. Welcome to the second quarter 2024 video review of the iSectors Inflation Protection and iSectors Precious Metals Allocations. My name is John Koch, iSectors Senior Investment Analyst, and I'm joined by the CEO and CIO of iSectors, Vern Sumnicht. In case you aren't familiar with these strategies, they're alternative models intended to be used as satellite strategies within a client's fully diversified investment portfolio. Inflation protection is a broad model focused on asset classes that have historically been resistant to inflationary pressures: commodities, natural resources, precious metals, and short-term tips. Last quarter, we made some slight changes to simplify the model and removed small allocations to real estate and rare earth metals. Precious metals, on the other hand, is a more focused model specifically targeting, you guessed it, precious metals like gold, silver, platinum, and palladium. The more focused nature of this model means that it's a bit more volatile than inflation protection, as you'll see once we get to the chart focusing on performance in the next slide. Last quarter, we also made a slight tweak in the precious metals model where platinum and palladium, we made them equal weight. Over the last year or so, we had been overweight platinum versus palladium, which had been a good trade for us, with palladium struggling over the last 12 months. But after doing some additional research last quarter, we decided it was a good time to go back to equal weight between the two, as they were beginning to approach price parity with, and now palladium is actually slightly cheaper than platinum for the first time in many years. So the way we see advisors utilizing these models, though, they tend to move in and out of them dependent upon inflation expectations and market sentiment, but that's really not how they're intended to be used, right, Vern? I mean, you use them for your clients. How do you see them utilized in a portfolio?
Right. Yeah, I think, trying to predict inflation is like trying to predict the stock market, is like trying to predict, bond prices. Nobody's good at that. And I think you need to think about an allocation. I think you need to think about what's the proper allocation for my client portfolio, and to think about your client and what their concerns are. Probably if you're maybe concerned about inflation, but also a little bit concerned about the value of the dollar, you may want precious metals as your inflation protection, like a little bit more. If you're worried about, just kind of a long-term allocation that's good for your client to protect the bond side of the portfolio, I kind of look at that's where I can lose money for my client relative to inflation, is that bond allocation. If the purchasing power, if his dollars go down, that's where I stand to have some risk. So maybe if I have a 40% allocation to fixed income, I want to have a 10% allocation to maybe our inflation protection model. We also have a 25% allocation within this model in short-term tips. It helps to reduce the volatility of the inflation protection model even more. I'll tend to, use 10% and I'll still use 5% in precious metals, because I'm much more concerned about inflation. I guess the Federal Reserve uses a lot of measures of inflation, but now they're using PCE and they're saying, well, it's about 2.5%. And I don't feel that good about that, just because money supply is going up and continues to go up, especially the M3 money supply, when you look at that broader measure that, that we calculate and look at. And then also, I think just on a practical standpoint, you can't talk to people and they're gonna believe inflation's 2%, right? It just doesn't seem right. It doesn't seem logical. In addition, you got a lot of fiscal spending, you got a lot of commitments, and I just don't see this getting better soon. So inflation protection is an important part of anybody's portfolio, in my opinion. And these are two models that we think are good ways to accomplish that. I don't know, John, other than that, you want to look at performance?
Yeah, let's bring up the performance. Now, you mentioned bonds, and maybe taking some out of a bond allocation and putting it into inflation protection. We have bonds charted here alongside our two models and the consumer price index. As you can see, then the green and blue lines here, both of our models have outpaced inflation and bonds in this period, the last 5 years, with this year, 2024, being having good performance for both models as well. You'll see the green line there, precious metals, a little bit of a bumpier ride than inflation protection, that volatility profile I mentioned earlier, but it has better returns though. So you note there again, the red line, just want to bring it up one last time, the aggregate bond index has not been able to keep pace with inflation since 2019. So this chart is a prime example of why we advocate for including these models or other hedging assets within a portfolio to provide true diversification.
Right. You do take on that volatility. I think clients need to be aware of that. It's not necessarily a smooth ride, but we're trying to preserve the purchasing power of their money for retirement. And I think I've been doing it for 40 years, and I've seen people that have left money in CDs their entire life. They think they're very safe, but their money doesn't buy anything when they want to retire, and everything seems too expensive. It's just the nature of the way inflation, or really purchasing power of your money, or the value of your dollar, depletes over time when there's more and more dollars being printed. The best way to protect that is to get some type of real asset, like the types of things we're trying to hold in precious metals and in inflation protection, and they will retain their value in dollars over time. Granted, it's volatile, as I said, but it's worth it to preserve their money. Anyway, thanks, John.
Absolutely.
That was
Yep.
well done.
If anyone wants to hear more, visit our website, give us a call. Thanks.